Yes, students. So we'll start with the next standard, a very small standard, hardly 16 questions are there and simple. So maybe probably we'll try to do it by today only. But before we proceed into this inventory valuation, okay, so I would like to just start with small examples so that we are very clear with the concepts. There are some theory questions also that I have bifurcated, that also we'll discuss. So before that, okay, you go to one vegetable shop owner. He has got so much inventories. How do you value now? What is the value of this? Cost or selling price? No, what is the value? How do you find out? Suppose you want to find out the value of this total stock right now, because you outright you want to, he asked me, can you tell me, can you guess? Since you know Ind AS 2, no? Tell me what is the value of this? Sale price? Fair value? No, I don't know. He is asking me what is cost. Is, you know, you are studying or studied or whatever, you know, Ind AS 2 or AS 2 also, because AS 2, Ind AS 2, not much difference. Cost or NRV, whichever is low. So what is the cost? That's the question he's asking you. He's not asking me how I should value it. See, be clear with the question. He's not asking me how should I value it. Then you just said, sir, please value it cost or NRV, whichever is low. Then he will ask you more question. What is NRV? That we are going to answer. Then he'll ask one more question to you. What is cost? You say, sir, your purchase price, direct cost, all apportionable. He has got one fridge. Should I add the cost of that fridge? If he is using one mango, which is costing 1 lakh rupees per mango, which should be fully refrigerated. Japan, there is one mango, no? You know that, no? 1 kg, some 2 or 3 lakh rupees. Now, it is a directly attributable cost. Okay. But one important problem comes. Okay, purchase cost means what? You have purchased, but when I have purchased 5, what is it called, watermelon. But right now I have got only 3 watermelon. And so many purchase and sales are happening every day. How? On what basis? 3 by 5? Okay. See, first of all, let us understand here. It's a basic, I'm telling. Okay, then keeping this in mind, whatever I am explaining, you look how the other every single question will fall in place. First of all, I will start with, I'll ask him basic question. Did you had any opening stock with you? Because I have got a cut off concept. Every year I start with one particular period. I'm not a continuous accounting there. Yes, he said 100 rupees. Now, what is the value of that 100 rupees? Sorry, he says I have got a 10 stocks. Let us take only one, say mango or one particular item we'll take. He said I had got 10 units. Now, what is the value of this? How did you get this? How did you get this? Simple. How do you get this? That's the same thing is the next. No. So, this is also Ind AS 2 only, which was done last year. So, I will take it for granted that it must have been followed with certain logic. Now, I will ask him, look, tell me, in the year, how much is your total purchases? 600. Did you incur any transportation cost? 500. Refrigeration cost? Yes. This is my total cost. Now, after incurring this total cost, did you sell everything? If you would have sold everything, then I would not have had any closing stocks. Entire amount, these two items together would have been what I call COGS, cost of sales, if I would have sold. But I didn't sell. Now what I will do? I have to value the closing stock, because whatever I have purchased, everything is not consumed, still something is lying. So how do I value the closing stock? First of all, I will go for the numbers. I'll count the values. I list, okay, I have got 5 kg this, 10 kg this, I have listed, say I have got 20 kg of this. But what is the cost of this 20? So now I need, because everything got mixed there, no? Or means constant buy, sale, everything is happening. Now I will ask him one question. Which method you use to sell your old stocks? There are two methods. fruit seller is going to follow? Which among the two methods he will follow? Sorry? LIFO. Tell me who will follow LIFO method? Either he will follow FIFO or he will follow weighted average. What he will do? Either see, yesterday's new stock is there still. He is waiting for the customers to come and take this old. So the moment old is disposed, he will bring that rate. Till that time, no stock only, Baba, no custom, this is I have to order. He will tell. Why? Because that person wants to get rid of the old stock first. That's what one of the example I told you. If they give means, if unknown vendor, you understand that there may be some chances are very high. Or alternatively, what he may do? Whatever yesterday came, no, he will just mix it with the, that's the weighted average. Like if you go to Super Bazaar and all, you see the potatoes, it is mixed up. Old potato and new potato got mixed up there. Because they don't do it. See, that means they have got certain practice. Ultimately, understand, friend, accounting what we do comes from the practice what they are doing. It's not that what we account and they should practice that way. I'll ask him, what is your methodology? Okay, if it is a FIFO, then I would have started 100 you had. Total 100 you purchased by incurring 1200 cost. So closing stock, since you follow FIFO, first in, first out. So whatever 12 remain or 20 remain, it must be from the recent stock. You will assign it and find out the balancing figure COX. So always the COX is the balancing figure. Closing stock is the calculated value. For that calculation, you need to take certain cost. Which cost should I take? That's what standard is going to tell you. Followed, no? COX is arrived through one equation. In your schedule 3 format, this and this is given as a together single item called change in inventory, and they will give you one purchases. So purchase plus change in inventory together forms your COGS. And on the credit side, you have got a revenue. Credit means at the top you have got a revenue. The difference between your revenue and cost becomes your gross profit. Simple, basic. Okay, what we do. Again, I was also not clear when I was doing in a company. Again, when teaching only struck marriage, it's a so simple thing. Now, if you have followed the weighted average method, that means his practice, understand, is to mix up everything. He is not interested to keep that old one first. What you would have done? You would have found out one average price and valued the closing stock, whatever is remaining, at an average price. And there will be some difference, not much difference. But LIFO is absolutely removed. You cannot follow the LIFO method. Why? The logic is, who will follow that? Given an accounting effect, you will follow. But in reality, are you following LIFO? Maybe wine company may follow. But that's an exception. That's a very exception. But if you talk any business practices, any business, their practice will be either weighted average or their practice will be FIFO. Now, this to be followed when you cannot go for specific identification method. Will you do this for that mango also, which you imported from Japan by paying 2 lakh rupees per kg? No, that is separately identified. So what is the value of this? That you have got a separate invoice, everything is there. These practices you do for certain things. So you need to understand when you value what type of inventory it is, what practices are followed, how the cost, and that this process of calculation of the cost is outside, it's not an accounting entry. After you calculate and value this, then you get that inventory effect in the systems. So what we are going, cost of goods sold is also known as cost of sales. It is the cost of goods sold is that are either manufactured or purchased and then sold. So revenue minus COGS is your gross profit. Now COGS is equal to cost of production plus change in the inventory. So this plus this, opening stock plus this is nothing but a change in inventory and your cost of production. Cost of production comes with, for the given level of production, what did you buy or what did you purchase? For that, how much cost you incurred? Which cost? Attributable cost. Anything non-attributable, then it will go outside. It will go and hit your P&L account. Otherwise, it will get loaded on the inventory, because that much cost you incur, you load it on the inventory, no profit, no loss for the year. But if you incur abnormal losses, you cannot load it on the inventory, it will go out. That's it. What if no sales are made? entire amount will come as a closing stock. So this one, okay, I hope this part is clear. What we present on the credit side, we bring it this side. Yes, so what we are going to discuss is a very small, with no time, is the cost of inventory. I just move fast. Inventory valuation technique, you know it, NRV. Hardly 1 or 2 or 3 problems are there which is very distinct, which has got a flavor of your costing. Material hours, labor hours, all those things, SCMP type of some flavor. We will focus on that question. Otherwise, simple questions we will not spend any time. Yes, but I should tell you some theory, before you move into practicals. So, recognition. When should you recognize inventory? Now, you need to recognize the inventory. What is an inventory? Inventory is an asset. 115 also says inventory is your asset. Why it is an asset? What is an asset? Because you are going to get future economic benefits. There are one question, okay, which I will give you as a part 2 question. There is one shipbuilding company, okay. In that shipbuilding company, the vendor, the customer gives certain spare items, spares, which has to be fitted there. Now, question is the item which is received from the customer to be fitted into the ship, is it an inventory? No. Spare part, no. If it is your spare parts, it is your inventory. If the customer gives to you, it is not your asset, because you don't have any future economic benefits out of it, because your job, you are acted as a bailey. Anyhow, I am just telling you, that's why this definition is what I discussed. See, job is what I have to have one computer. Okay, I am a computer manufacturer. You are my customer. You do one thing, that you say that, sir, along with this computer, this what is it called, webcam also I want. Okay, if I procure this webcam, this becomes my inventory, which is used in the production process. But the problem is, webcam you will give it to me, and at the end of the year I have not yet delivered this finished product to you. Now this webcam is with you. With whom? Is it my inventory? That's not inventory. But how do you answer it? You should start with the definition of an inventory, because inventory is something which should give the future economic benefits, but this is not going to give me, because on this you will give me only service charges. This asset is yours and will remain yours only. Followed, no? What I am doing is I am just fitting it and taking service charges for that. So it cannot become my inventory. It is your inventory. I have acted like a bailey. No, in the part 2, the new generation questions, because sometimes we will not understand what type of question it is. That type. Anyhow, I will share it later. So inventory can be an asset which can have 3 forms. One, held for sale, which is your FG. Process of production, which is WIP, or it can be raw material and the supplies which are consumed in the process of production. So it can be FG, WIP, raw material, inventory. How do you measure the inventory? Simple, standard, generic rule, lower of cost or NRV, because it is the current asset that more than NRV cannot value it. Now, question comes, what is cost? Cost should be only attributable, directly attributable cost, which is necessary to incur, so that I can ready to sell it or ready to use it. All cost of purchase, conversion and other cost to bring it to the present location and condition should be added. Now, what is NRV? NRV is the estimated selling price. It is not a fair value. It is an estimated price less estimated cost of completion. If we have to do something small, packing or something, and estimated cost to sell, packing cost, and some completion charges. Okay, now let us go into detail of this. Let us expand. We started with the measurement, cost or NRV. We discussed about the cost. Cost includes this. What do you mean by cost of purchase? We need a clarity, no? So the cost of purchase includes your list price, import duties, transportation, etc., excluding trade discount. Then what is your cost of convert? Trade discount and rebates. If your list on list price, if trade discounts are given, will you treat it as part of your inventory cost? Deducted. That's what I need from the list price, I should deduct. If you ignore it, that means you are considering it. You are valuing your inventory stock by ignoring the trade discount. Are you clear? Now, what do you mean by conversion? Conversion includes your direct material, direct labor, other direct cost, and the catch, overhead allocation. Now, when you talk about overhead, overhead can take two forms, fixed overheads or variable overheads. And then they said, look, other cost of bringing this inventory to your present location and condition. So these are all the three components should be forming part of your cost of inventory, and this cost is used later using inventory valuation technique depending upon your business practice, whether LIFO or FIFO. Now, what do you mean by allocation? How to allocate? See, there is absolutely no confusion when it comes to allocation of the variable overheads. How do you allocate variable overheads? Production. If I don't produce, I don't incur. So how to allocate? Allocate it based on the production. How to allocate the fixed overheads? Now comes a problem, and that's called a normal capacity. See, normal capacity is like an expectation. If you work up to expectation, or if you work more than expectation, okay, so you can, or you may work up less than expectation. If your actual production, that is your actual performance, is equal to expected performance, normal capacity, then you distribute based on actual performance or normal capacity. It doesn't make any difference at all. Your actual production is 5, normal capacity is 5 lakh units. Actual production is also same. You incur on fixed cost. What accounting entry you pass? Fixed cost expenses account, debit to bank. And that fixed cost you debit to the P&L account. If I had to prepare a P&L account, fixed cost 15 lakhs you debit. Let us simplicity say you didn't sell only. How much inventory you should recognize at the end of the year? Since you produced and met your expectation, doesn't matter 15 lakhs divided by normal capacity into actual production or actual production by normal, you do anything, entire 15 lakhs you will recognize, and there is no hit to your P&L account because you have met your expectation. Should you be punished by debiting something to P&L account? No. So when you do actual production meets normal capacity, allocate based on the normal capacity. Now, if the actual production exceeds normal capacity, so 7,50,000 is the actual production, normal capacity is 5 lakhs, then you should actually charge based on the actual production. Because if at this point of time, if you start charging based on the normal capacity, you inventorize more than what you have actually incurred. I'll give you this example again. How much you incurred? 15 lakhs. How much is your normal capacity? 5 lakhs. So 15 divided by 5 into 7.5. If you do this, no, your inventory cost comes to 22.5. Correct, no? So makes no sense. Arey Baba, you didn't incur the cost only, how can you inventorize? Allocation is a calculation, no? I need to think, okay, did I use this building for this production purpose? Yes. Am I paying a fixed rent for this building? Yes, that is my fixed cost. How much I should allocate to the inventory at any point of time in my hand? That's what, how much should go? You always say proportionate. To what? Now, if your actual production is more than the normal capacity, in proportion to the production. So what you need to do? 15 lakhs divided by 7.5 into 7.5 means 15 only. Again, because you are efficient and you are far more efficient, how can I penalize you? I cannot penalize you, no. Understood this logic? Now let me go to a situation where somebody is inefficient. So punishment is required. When is that? What do you mean by inefficiency? That means your actual production is less than normal capacity. Then the standard says if the actual production is less than normal capacity, you have to allocate it based on the normal capacity. So now how much you will allocate to the inventory is actual production into cost per unit, that is 15 lakh divided by 5 lakhs. And what happened to the balance amount? It will hit P&L account. How it is going to hit my P&L account? It goes like this. See the effect here. You have incurred, this is your P&L, you incurred 15 lakhs your overhead. So you passed an accounting entry, overhead expense account debit to bank, and P&L account debit to overhead expense. At the end of the year, you have got everything is in your inventory. So what is your closing stock value? It's cost or NRV, whichever is low. Let us assume that NRV is very high. So I need to only look for the cost. For time being, let us assume that all other costs are zero. For time being, Now only cost comes is my allocation of the overheads. How much is my normal capacity? 5 lakhs. How much you actually produce? 2.5. So what is the value of 2.5 out of 15? How much I should give to 2.5? Can you tell me the amount? It is 15 lakhs divided by normal capacity 5 into 2.5, it comes 7.5. And if I complete the balance sheet, I get a net loss 7.5. This is my hit to P&L. By this hit to P&L, no? That's why they say that should not be inventorized, it should be moved to P&L. This is the language they use. What is the meaning of that language? Don't inventorize. Don't inventorize means don't include in the calculation of the valuation of the inventory. Let it go to the P&L account. Abnormal cost should go to P&L account. That means if it is an abnormal cost, don't load it on the inventory. Don't include that in the calculation. The moment you don't include in the calculation, automatically your credit will be low, and the credit is low more than debit, you will have a net loss. And the moment somebody sees a net loss, they will ask you one question: what happened? And if I permit you to allocate it based on the actual production, you will hide it, your inefficiencies. That's why objective of this accounting standard is, if you have made some inefficiencies, abnormal losses, don't inventorize it and take it to the balance sheet. Because inventorizing means not allowing it to hit your P&L account. P&L is your performance, results. And this we should not allow it to tamper. That's why every standard, see this standard is going to touch your financials, P&L. Revenue recognition, we have seen so much discussion, so many ways people are trying to do. See, people will try to do issuance. If you don't allow to touch this, they will go to depreciation. Will we permit? No, PP we already told, change in the method of depreciation, this, that, how you should come, what disclosures need to become. So literally, through all different standards, we will not allow you to manipulate. Only thing is, what is the truth, reflect it. That's it. That's the final message Ind AS is going to give. Will not permit any window dressing there. That's why understanding this is very important, going deeper, because people would have tried to manipulate that somewhere or the other. And that is what we have to figure it out. Now, other cost, and this is all the product of learning. Other cost includes what? All the cost to bring to their present location and condition, and even borrowing cost. You remember in Ind AS 23 we discussed, if something is part of your inventorization, okay, you take it there only. Okay, then you can come to the qualified asset, because again inventories also is a qualifying asset. Borrowing cost also you can capitalize it. This does not include abnormal wastages, don't include in your allocation. Storage cost unless it is required by the production process, like specific inventory, like that mango case. Administrative overheads and selling cost. Yes. Being held with the no, I didn't get you. Which asset is it? On repetitive basis. See, first of all, what is the definition of a qualifying asset? Ind AS 23 says that which takes substantial period of time. So that we have to apply that. Something you can do it very fast on repetitive basis. You cannot inventorize that. That's why this comes from the Ind AS 23. If something is not a qualifying asset, no question on of capitalizing. That means borrowing cost can be the part of the inventory. Yes. So next, inventory valuation technique. Okay, let us see some theoretical question quickly, and then probably we'll see some problems also on cost of inventory. We'll see some problems. These are new type of problems, which I don't know whether you have come across or not. Yes, the first question, very simple, 4-mark question. Venus Trading purchases car from several countries and sells to several countries. And they have incurred the following expenses: trade discount, handling, salaries of the accounts department, commission to the sales agent, after sales warranty, import duty, cost of purchases, freight, insurance, brokerage. Evaluate which of these should be allowed as per Ind AS 2 for inclusion in the cost of inventory. Which should not be allowed, you tell me. Salary to accounting department, Sales commission. Sorry? Last, brokerage and commission paid to intending agents. If you what do you mean by intending agents? Now your ship has come there, that clearing agents are there, no? If you don't pay commission, intending, okay, so they need to, no, okay, again, you understood, no? So these people are required to bring your inventory to your present location, no? If you don't pay a commission, they will allow it, demurrage will start coming now. Then after sales warranty, import duty, it will not cross custom, this thing, they will not permit it. Cost of purchase, freight, expense, yes, only 3 things. So you will write answer, item number so and so will be included as part because they are directly located. Salaries of the accounts, warranty cost, sales commission will not be allowed. Therefore, they are not allowed as per Ind AS 2 because they are, and what they are done, they are expensed off. What is the meaning of expensed off in the P&L? Nothing. You pass accounting entry transfer to the P&L account. In the end of the year for valuation of inventory, you don't add it. That's it. Automatically it becomes an expense. That's what we call expense off. Next question, again, low probability, I don't know. They purchased motorcycles, cost of purchases, trade discount, import duty, freight. Okay, sharp trading is seeking your advice, which of the items to be included and calculate the cost of inventory. Yes, students, so please pause the video and tell me the number. You can use the calculator only here. Yes, so we'll compare. How much answer? First of all, see how many questions are there? 2 questions. One is theoretical question, why you should include or why you should not include. And second is the calculations. Okay, as compared to the previous question, I would give high priority to this because numbers are there. This how much is the value of the inventory? 90,000. Everybody? Trade discount on purchase is already deducted. So you would have got 4,91,000. Yeah, you can take it separately also. So 4,90,850. So where you show it separately. That doesn't matter. If you assume, because question is very silent, if you already assume that it is 5 lakh is after deduction, doesn't matter. But you give your assumption very clear. Sorry? That's what 5 lakh is after deduction. So if you don't deduct, then it's 4,91,000. Oh, sorry, 5 lakh 850. Doesn't matter, give your assumptions. I don't know, easy, right? At this point, if I start consolidation, full, so much happen. Okay, ABC buys goods from the overseas supplier. It has recently taken delivery of 1,000 units of component X. The quoted price of the component is 1,200. And ABC has negotiated a trade discount of 5% due to the size of the order. And they also offered early discount for 2% for cash payment. Import duties 60 rupees must be paid before the goods are released from the customer. Once they are through, must pay delivery charges of 5,000. What is my inventory cost? Yes, students, you can pause the video and you can calculate. How much is my inventory cost? 1 lakh. Sorry? 11 lakh? 45,000. Okay, 3 numbers are there. Yes, Julia. So how much? It doesn't matter. No one tell. Let us see who is going to 60, 2 lakh. See how many differences, if this question is going to come in the exam. So you, even though, see, this can be part of another question there. Tricky question. Okay, let us see now the solution. You are eager, no? All are eager to see now. Any other different answer, Sana? Okay. 12 lakh 5,000 is the correct answer. So your purchase, just check. Let us see. Mistakes welcome. Please see where it went wrong. 1,000 units you have purchased at 1,200. Net of your 5% discount. Are you going to take the cash discount? Cash discount? No, but you have to give there. See, when you, I always have been telling you, you took the cash discount. Whatever, I should, no problem, no problem. See, it's a simple, that's why I'm moving like this. Otherwise, we would have solved it. Now, always remember, I'm telling you, what you don't adjust, please give a note. Then import duty 1000 into 60 and delivery cost. Is there anything which is left out? Yes. Any other adjustment? Yes. What happened? Okay, you multiplied twice. 60,000 you didn't consider. Okay, are you clear now? Yes. Now you should please work out and tell me. Okay. This time no calculator. Huh? I want everyone to work out. This is a high probable 4-mark question. A dealer has purchased 1000 cars costing 2,80,000 on a deferred payment of 25,000 rupees per month to be paid in equal installments of 12. At the end of 20 cars are in stock. Now you need to compute the cost of goods sold, because that means out of 1000, if 20 is stock, that means 980 must have sold. No, what's the cost of this? Finance cost and inventory carrying amount. Yes, please do it the way you have understood it, the way you do it. Please pause the video, students, do the working. Let us compare, then we will compare the answer. Yes, sure. So let us please tell me what is my cost. 20? Yeah. 27 crore, 40 lakhs, 44 lakhs, 20, 40 lakhs. Any other number for Cox? Okay, inventory 56 and finance cost 20 lakhs. Yes, others got these numbers? No? Okay, let us check now. See, first of all, see, your car is costing 2.8, and by doing deferred payment, how much you end up paying? 25,000 into 12. So your total interest expense is 20,000. That's your finance cost. 20,000, no? Per car. Now, that's what they said, compute. So first finance interest cost you need to calculate as a working note. Now what is your COX? 20 cars into 2.8, 56 lakhs. Yes, 56 lakhs, perfect. Finance cost is 1000 cars into 20, 2 crore. Okay, you said 2 crore here, no? Okay, I assume you would have told me, and I might have written something different there. And COX is 27.44. 27.44. Understood now? Yes, others, any other number, any way of misunderstanding? See, it's simple. Did you load this finance cost on the inventory? You should not, no? You should not load. That's why it will go to the P&L account. If yes, it would have got added. Okay, so your COX is without, if you look into the COX, this does not include your finance cost. Finance cost, you separately present it. Cost of borrowing cost, that is borrowing cost incurred to manufacture or buy this, and if it is a qualifying asset. This finance cost is what? This is you have paid, maybe, yeah, finance cost, yeah, this is the finance cost, but can you capitalize this? No, this is that borrowing cost, correct. Why? Because this inventory is not a qualifying asset, no, it is ready for sale now, ready for use. If you have incurred a borrowing cost, which is going to take a substantial, so this finance cost can be capitalized. Okay, this would have been my accounting entries. You can look later. I just shared with you how to get this COX and all for your academic interest. Yes, now the overhead allocation. So I'll take theoretically, okay, because anyhow you can practice this question. This question has already come for the exam, and it has come when it was sitting as an example. Understand? So they will ask you questions from example also. Pluto Limited has a plant with the normal capacity to produce 5 lakh units, and the expected overheads is 15 lakhs. Which one? fixed. See, the moment you see fixed overheads, you have to look for normal capacity in the question. Not this, every question, because we are going to come across now different questions where we have to calculate the value of the inventory. Sometimes they give me overheads and all. The moment you see fixed, no, you have to see normal capacity. That normal capacity can be normal machine hours, it can be labor hours. Be careful there, because this brings no costing flavor. The allocation can happen based on the machine hours, or it can be happening based on labor hours or machine capacity. Now, what is your normal? You have, since you have got a fixed, do you have a capacity information here? Yes, they told you normal capacity also. And fixed overheads based on normal capacity is 3 rupees per unit. Now, determine means you have to tell specifically that, look, if this production is so and so, this should be allocated so and so. Value of inventory, if the actual production is 5, 3.75, 5. So, if the actual production is 5, what is the value of the inventory? 15. So, since did they say calculate or determine? What you will write? Since actual production, the allocation should go, otherwise, okay, it can go with this. So, you are going to say that when the actual production is equal to normal capacity, the fixed overheads shall be allocated based on the normal capacity. This is what standard tells you. There is no confusion on that. That is why you tell very specifically this is what needs to be done. Why? So that it does not lead to any under or over absorption. If you follow any other method, no, either it will be under absorbed or over absorbed. You would have ended up charging more or less. You should go with this. Thus, the cost allocated for the inventory is 15 lakhs. And how much cost will go to P&L account? Nil. See, this is the presentation in the examination. See, one thing is you know it. You know 5 lakh into 3 rupees. But how do you tell that so that get full out of full marks? You have to tell like this. Clear? Next, if it is actually 3.75, how much will go to my overhead? Sorry? 11 lakh and balance P&L. Okay? Yeah, now you know very well. If the actual production is less than the normal capacity, it should go with the normal capacity. Thus, 11 lakh 25 will go to the allocation of the inventory, balance 3.75 will go to the P&L. And if the production is more, then you should allocate based on the actual production. If you don't do this, you should explain what is going to happen. You will end up charging 22.5 while incurring only 15 lakh rupees. It becomes over absorption. Thus, the allocated inventory will be 15 and charged to P&L nil because there is no inefficiency. That's why you see that only when the actual production is less than normal capacity, you see one element of inefficiency. Clear? And this question came in your examination for 4 marks. And when they asked for the 4 marks, again they said determine. They have got a plant with the normal capacity. They just tripled the number there. And actual production and this is just 4 marks, 2 elements they asked. See, the point here is not even calculation. Calculation may fetch, I don't know, maybe 1 mark or 2 marks. The point here is you have to explain why. If this question comes to your examination, you have to first explain why you are doing it. What has been told to you? Told to you means told by the standard. It will lead to overvaluation, it will lead to undervaluation, there will be one element of cost. See, if you do it otherwise than normal capacity here, it will lead to overvaluation due to inefficiency will get inventorized. And then no hit will come to P&L account. That explanation you need to give. Are you clear? Otherwise, if you do it, then you will end up charging more to P&L inventory rather than what you have actually incurred. That's why these rules are designed by the Ind AS too. Based on this, we will allocate like this. So, understood how to answer the exam questions? Yes. So, with this, with the 6 questions, we are almost done with the theoretical questions on cost. Okay, now we will start with the practical question, which is awaited from much long time. Correct, no? Yes, take out question number 1. On 1st of January 2011, an entity accepted an order for 7,000 custom made gift. Now, on 3rd of January, they purchased raw material to be consumed in the production process, which is 5.5, including 50,000 refundable purchase taxes. So this refundable should not be part of my cost. The purchase price was funded by raising a loan of 5.5, including 5,000 loan raising fees. The loan is secured by the inventories. You might have secured it, but it is not a qualifying asset. No, it's not going to take that. Gift manufacturing and all doesn't take time, so ignore it. During the year, entity designated designed the corporate gift for the customer. Design cost includes labor, external design. Should it be part of the inventory? Yes. Okay, because it is specifically you incurred for this design, and this design is useless after you use this for this particular case. During the month of February, entity's production team developed the manufacturing technique to make the specification. As per the specification, following cost were incurred: materials, net of scrap, labor, depreciation on the plant used to perform the modifications, 5,000. Now, during the year February, the entity incurred the following additional cost on manufacturing the corporate gifts: consumables, labor, depreciation. I think it's the same. Yeah, sorry. Yeah, I also didn't observe this. Yeah, this was the testing phase, and this was the manufacturing phase. Yeah, and I got missed for some time. Now, the customized corporate gifts were ready on 1st of March. No, did you sell it? No, if you have sold, then Ind AS 2 is not applicable. No? So, no abnormal costs were incurred. That means whatever cost you incur, you should load here. Compute the cost of inventory. Substantiate your answer with the appropriate reasons and calculations wherever required. So, what is my cost of inventory? Okay, so there is one format. Okay, just if it comes for the exam, it has come actually. You can follow. First, working note 1, product testing cost for specific customer product testing cost. So, should I charge the testing cost to the inventory or P&L account? Which one? See, who are you? You are preparing some corporate gift like what is that called, balloon or something. Say for example, with the printed something. What is your FG? Is it an inventory for you? Why it is not an inventory? You are selling, no? You entity accepted an order. Your job is to manufacture that gift cards or whatever. Which one? No. Array, I am telling you, see students, one more khatarnak case is there, which I will give you as a case too. I could not go through there, but somewhere in RTP it has come. These doctors are given some gifts, no? Some sample, they are asking inventory question on that. Is that sample material is a gift or it is an inventory? So be careful, okay? We cannot underestimate at a final level, but few questions, not all the questions. Are you clear? Yeah, see, perception can take somewhere like this also. Yes, it's an inventory. Are you clear now? Okay, so first write. How much is your material? Okay, should I charge this testing cost to P&L account or inventorize? That is only in intangible assets. The testing phase will go to P&L, not here. So first you write material net of scrap sales, because that much income you got. Materials net of scrap sales. What I am going to add it? Labor am I going to add during testing phase? Yes. Labor 11,000. Now you will tell me, sir, it will start with some other cost, no? No, why we are starting with this working note? Because the verb is compute there. Please note, otherwise you will lose 1 mark for this simply. This question has come in the exam. 1 or 2, God knows how much they will allocate. Depreciation 5,000. So first thing, you simply calculate 37,000 as a testing cost. Net of 3,000 scrap sale means you have purchased some what is that called? What is that called? One paper, long paper, and you have cut it into equal size pieces. So some scrap sale remain. What you will do? You sell now. So whatever you have sold, scrap sale, that material cost, from the cost of the material only you deduct. In fact, that is also your inventory if you keep it. But scrap inventory, it is like a byproduct. We will see later what to do with the byproduct. They say that if it is a joint product, then allocate it. If it is a byproduct, then whatever sales value you realize, you deduct it from the main. So it's a byproduct for this. No, it's not a joint product. So this application we'll discuss later. Clear? Yes. Now we will calculate the cost of the inventory. See, understand students in this question. The question is compute the cost of inventory. So we had to have one working note. Then they said substantiate question with the answer. So simply you would have done one calculated statement. Oh, my cost of inventory is so much. You would have terribly lost the marks. You are clear now, students? See, this question is specifically asking you the explanations. So you have to write one explanation. So first write cost of purchase. How much? 5,50,000. Are you going to include it? 5 lakh, okay, net of, I can show it separately, but am I going to include 5,50,000? Why? Okay, you can say either directly or you can say purchase cost. This is the explanation. They said suitable explanation has to be given. You cannot ignore that sentence. Otherwise, your calculations you will do. See, understand here. You will do the calculation and tell the number. How many marks next question has come for? 5 marks, no? For that calculation, you will get 1 mark. For 5 mark question. Next question, next question. This question has come now in the exam. You will get only 1 mark. Answer is correct. But what happened? Explanation not given, working not done there. Next, refundable tax am I going to reduce? Yes. What I need to say? Net of purchase cost. And when you present an answer completely like this based on what they have asked, you get full. I am telling you, here, there only you will lose lot many marks. With the and one thing here, there, just focus, simple. Who is going to stop you? Okay, loan processing fees, not to be. So what is their answer? Amortized with the liability. It will not be loaded on the inventory. Or inventory is not a qualifying asset here. How? It is 109, no? So what is your accounting entry for loan processing fees? Transaction cost account debit to cash. Now what you will do with the debit to the transaction cost? Will you do inventory account debit to transaction cost? No, inventory loan account debit to transaction cost. Means you are going to amortize it. With the your EIR is going to change. We have done no 109. No, it's a journal entry. You just go with the journal entry, you have figured it out, everything. Next, consumables. How much? 55,000. You say it is a direct cost. Will you include your labor cost? What is your what do you say? Why you should include it? Cost of conversion. I don't know what they will consider, but it's a conversion cost. No, labor is a conversion cost. You see, I showed you one chart where the material cost is there, conversion cost is there, and then other cost. So it is going to fall under which one? Direct material under come where? We said cost of purchase, no? Maybe we should say cost of conversion. This is this direct cost, this consumables is the cost of conversion, because it's not a direct material, correct? No, direct material is your this is your direct material. See, this is your direct material, this is direct material, this is all conversion cost. Depreciation, conversion cost or fixed production overhead. Now, okay, what is this depreciation on what? What did they say? What did they say? Depreciation of the plant used to manufacture the customized gift. No. It's a direct production cost. I told you direct production cost will have two things, fixed and variable. This is a fixed one. Because maybe probably for that gift manufacturing, you need one specialized equipment. That equipment you cannot use anywhere else. So depreciation should be loaded, no? Testing fees, I am going to add it like a design cost. Other cost I will add it as a testing cost. Which one? That we added in this 37,000, no? That 5,000 is added here, no? In the testing fees. That 5,000 rupees, the testing fees depreciation is in 37,000. This is another phase. This is a production phase. During testing of, see, first of all, you understand the business here. Somebody comes and asks, I want 7,000 gift. It is a big order. If I mess up there, then I have to bear that cost of 7,000. So will I do some testing, how it looks, how it comes like? I will take the customer approval. Will I take that customer approval and all? For this, I incur this 37,000 because some sample basis and all I do. Then afterwards, I start manufacturing. After customer says, okay, this design is okay. These are all the cost of manufacturing for me. Plus my other cost of testing also I am going to add it. Clear now, Prithvi? Which plant? I didn't get you. Yeah, one portion. PP, I don't know. They have not told me. Cost may be 10 lakh or 10. That's what. No. Yeah. Very good. Very good. Okay. What accounting entry? See, that's what I'm telling you. I started with that first basic one format and all. What accounting entry do you pass for the depreciation? Depreciation account debit to PP. So have you reduced it from the value of the PP? Yes. On the asset side of the balance sheet, you reduce from the PP and show this balance sheet. Now only question is what you will do with this depreciation account. So you say you go to P&L account and debit depreciation. Now comes the closing stock. Will you load this and include in the calculation of the value of inventory? This is what is then outside the balance sheet? No. If your answer is yes, that this depreciation is inventorized and again it will go to the balance sheet. Previously it was part of the PP and this time this depreciation is part of the inventory. If you say no, then closing inventory is 0 because you didn't load it, it will hit your P&L account. That's why you can avoid something going to P&L account with all these tactics. Somewhere here, somewhere that is PP there. This is your doubt. Now where? Are you clear now? So we need to know how things move, how the accounting entries happen, how the valuations happen. Because ultimately our objective is true and fair. No. Now you say, yes, is this inventory true and fair? Yes, 6,82,000 is true and fair. Because what has been told by Ind AS 2 to be part of this inventory cost at that point of time has been loaded. Now something which was not supposed to be gone, which should hit to your P&L account, has not been loaded. Not loaded means it has not been included in the calculation. So automatically it will hit your P&L account. Clear, no? You have any other different? Yes, students? Okay. That's what. Now it's simple. You just understand the terminologies there. Okay. Can I proceed further? Yes. Inventories because I am using it for this only, no? I'll get it back. That money will come back to me. See, ultimately the purpose of charging depreciation is you have to retain some money. Now I will retain it through, and this Ind AS 16 time we discussed what the purpose of charging depreciation. Ultimately, otherwise what happens? Your balance sheet will remain one day, only balance sheet. Behind that nothing, no cash, no nothing. It becomes one piece of paper. Now what happened? Through depreciation, this value is loaded on the inventory and inventory is retained there. That's why you value them at cost, because your realizable value is more than that. If it was not more than that, that would have gone to your P&L account through that route. That's why I will check there also. I have got one check there, not to allow it more than, what is that called? NRV, less than NRV. Otherwise, I will load there, no. If I can't realize, then go take it to P&L account. What's the fun in depreciation, you loading it on the stock? Normal capacity or whatever it's a fixed overhead cost, so it goes with the reasonable allocation. Normal capacity, but question is silent here. So we'll assume that what is allocated is based on the normal capacity. Are you clear? Yes, Dhanush. And it's a matching also, because I didn't sell it. If I would have sold it, no inventory, everything would have been COGS and corresponding revenue would have been there. The matching concept. Very nice. Okay, clear? Done? Yes. So next question. Okay, I don't want you to write explanations and all. You just please go through and see if there is any odd, same, no? Yes, students. So pause the video and do it. Just tell me the number. If you want to use a calculator, also fine. Yes. So we'll compare. I don't think so any catch is there. Easy plain question, no? Catch is only this compute, and your answer should be supported by explanations and calculations wherever necessary. This is the only catch there. So first is the working note number 1, 67,000, and then you will add plus with the explanations 25 lakhs is the total cost. Any mistakes anywhere? So you have included raw material purchases, consumables, conversion, overheads, production overheads, fixed cost, and product design cost, and the other cost. Yes, so we'll move on to the next question. It is the illustration 3. A business plans for production overhead of 10 lakh rupees per annum. Now you are going to incur 10 lakh rupees production overhead. See, the moment it is the production overhead, see, assuming it to be fixed, you should look for the capacity now for allocation purpose. And what is your normal level of capacity? 1 lakh. So how much is normal rate per unit? 10. Due to supply difficulties, business was only able to make 75,000 units in the current year. Other unit costs were 126. Now what is your calculate the per unit cost and the amount of overhead to be expensed during the year? How many questions? 2 questions. What is per unit cost means? What do you understand by per unit cost? Okay, students, can you pause the video and do this? Just tell me 2 numbers. Yes, students. So we'll check the answers. Okay, again, it's a small concept, so you can just leave the space also to work. So they asked you cost per unit. What is mean by cost per unit? It's the inventory cost per unit. What is the cost of inventory at the end of the year? So inventory cost, you can write cost per unit is equal to 126 other cost, variable cost, material cost, God knows, plus how much fixed cost you will allocate? Rupees 10, 136. Now when you have allocated 10, you have assumed that your production, actual production will be definitely equal to normal capacity and more than or less than. If you have allocated 10 based on the normal capacity, okay, because they have made the less than 75,000. So if you have got less than 75,000, yes, then balance amount will go to your P&L. So how much will go to P&L? 10 lakh you have incurred minus how much you have inventorized? 75,000 into 10, 7 lakh 50, 2 lakh 50. So this is your inventory cost per unit. And how much you have absorbed? Out of 10 lakh incurred, 7 lakh 50 goes, 2 lakh will charge to P&L account. So what is the meaning of this charge to P&L account? You charge full 10 lakh only. Only thing is 7.5 you inventorized, and that is what you show on this side. You minus it here, change in inventory. So how much hit to the P&L? Only 2.5 is the hit to the P&L. Very important question, mark this. I think NS new syllabus update, no? Is there in the illustration number or something? Illustration. Okay, please see this question. This question is a bit confusing. There are two ways to solve it, but let us follow the ICA method. Okay. Following is the relevant information, and because nicely crafted question with the nice numbers. Full capacity is 10,000 labor hours. That means your organization must be labor intensive company. So don't follow any other method to allocate. Don't go allocation based on the normal capacity, because they gave you normal capacity also. Labor hours. Normal capacity, full capacity. Which one should go for? No. Okay. Full capacity means, like, suppose you come across somebody, you want to buy one scooter. That person says 200 kilometer mileage. That's full capacity. Provided what they do, your vehicle doesn't move. You put 1 liter petrol and simply start and put the accelerator. That means it is an ideal. If most likely, if all the conditions are true, then you will get 100 and 200 kilometer mileage per liter. But in reality, will you get? No. Normally, for a normal usage of your whatever your environment, this is 100 hours, 100 kilometers per liter I may get. So full capacity is like a manufacturer's capacity. This is the best case. So we will just ignore this full capacity. We will always take the normal capacity for our calculation. Actual labor hours for the current period is 6,500. Total fixed production overheads is rupees 1,500. This is your cost. Total variable production overheads is 2,500. This allocation is going to be based on the actual. This allocation is going to be based on the normal. Total opening inventory is 2,500 units. Units produced during the year is 6,500. Units sold is 6,700. Now, which method to be used? FIFO cost formula to be used. So, whatever latest is the cost. Now, how the overhead cost are to be allocated to the COGS and inventory? Now, what is your overheads cost? Forget about other cost. What is your total overheads cost? These two are my overhead cost. Will you allocate to the inventory? Can you allocate to the inventory first? Yes. My standard as permitted be, provided these are all directly incurred. So I will assume it to be the direct overhead cost. Now, how do I allocate this? Based on the actual. What? Units produced or hours? Hours, because my normal capacity and actual hours are given in terms of hours. And see, why I am telling you it is nicely crafted. Whether you make it based on the units or not, it doesn't make any difference, students. Your actual units also 6,500 hours. I'll tell you later. So ICA method looks confusing, but let us follow that. Otherwise, other method also I can get the answer. The cost assigned by the FIFO method, okay, how it should be calculated. So first, these two numbers will be different in the exam. If not given, take assumption that FIFO will be used. Why? We will see. Allocation of the fixed hours, they may specifically tell that allocate based on the labor hours. If not based on the number of units. Yeah, because they said normal capacity is labor hours. No. So we have to assume that this must be a labor intensive. They have not told me. You could have told, see, for one normal capacity is 7,500 labor hours. Okay. For normal units, 6,500, because actual 6,500, like 1 hour is equal to 1 unit. Then my normal capacity also must be, unit also must be 7,500. You can go with that assumption. Numbers you will get correctly, but not acceptable. So this particular question I tell, please do it in ICA way. See, it's understandable. First, to calculate, what did they ask me? COGS to be allocated to the COGS and closing stock. What is my closing stock? No. So first we will do one working note. Working note 1. closing stock units. Opening stock 2500, add production 6500. Any question? Plus look into the closing stock first. You have sold 6700. So 2300 becomes your closing stock. Now how allocation has to be done? You have incurred variable cost. Variable cost, no headache, based on the actual hours you incur. You incur 1500 rupees fixed cost. How the allocation has to be done for this inventory? Question is clear? See, you incurred 1500 rupees fixed. You incur some variable also. Variable I am not disputing now. Straight away we will write allocation, write the heading allocation. 1. Variable overhead of rupees 2600 is allocated based on what? Actual labor hours. There is no dispute there. There is no confusion. Actual hours, labor hours. Now my only doubt is fixed overhead of rupees 1500. How should I allocate? Why I should allocate based on normal capacity? Because it should be allocated based on normal capacity, as actual hours is less than normal capacity. So any inefficiency is there, we have to bring it out, let it go to the costs. You cannot inventorize it. Sorry, clear? So since fixed overhead is 1500, you have to allocate based on the normal capacity. Yes, so next we will see how time it takes for one unit, how much labor hours is going. This is what I told, in examination it may be different number. Here it is nice number 6500, 6500, but be careful, calculation of labor hours per unit, and then you will calculate the cost of labor hours and see how much units are produced into that much cost. So how much actual hours spent? 6500. How much is your actual production? So A divided by B gives you 1 hour per unit. So you are going to incur, to manufacture 1 unit, it takes 1 hour. Since allocation of the cost should happen based on the labor hours, what is my cost of 1 labor hour? 1 hour. If I have to engage any laborer, because in mine labor intensive, what is the cost of that laborer for 1 hour? Costing, no? Pure. Then you find that and see how much closing stock is remaining. To have that closing stock, how much hours was required? Multiply with this, finish. Okay, next working note number 3, labor, you need rate per hour. See, I found out for 1 unit how much hours it's going to take, and what is my cost of 1 hour? Can you tell me, student? See, first to tell you about the cost of 1 hour, I have got 2 elements of overheads. One is variable. How much is my cost of labor, variable overhead cost per hour? Per hour. I incurred 2600 rupees divided by what? 6500 hours, actual hours. Is it because it's a variable? So 0.40 per hour. Yes, Sana. Costing will not go, no? Even the SCMP has gone. Anyhow. For me also it was very, I will show you ICA way also. Now what about the fixed? You incurred 1500 divided by 7500 hours, which is normal. Why do you take for normal? Because your actual labor hours are less than the normal capacity. You thought they will work for 7500 hours, but they are inefficient. They worked only for 6500 hours. That's why you allocate it based on normal. In the examination, they give you a twist. They work more than the normal capacity. Then allocate it based on the actual hours. 0.20 per hour. So total 0.60 per hour is the cost of the labor. Yes, now we will calculate the, with these three working notes, we have got all the required information with us. One, valuation of the closing stock or closing stock value. See how much closing stock you have got. 2300 units. My allocation is going to happen based on what? Labor hours. So how many labor hours I spent to manufacture this? So I'll write the heading total labor hours for the closing stock. If I have got 2300 units at me at the end of the year, to do this I have some labor intensive thing, material cost and all immaterial there. How much hours I have spent? 2300, because for one unit it will take 1 hour, which we already did in working note number 2. In working note number 1 I got this number. In working note number 2 I got this number. I came to know that it will take me total 2300 hours. And what is my cost of labor per hour, which is working note number 3? Rupees 0.60. Are you clear, students? Very nice question. Don't you feel like that very probable question? Huh? It has not come. That's why high probable in your upcoming attempts. All these things which was sitting in the RTP never came, but new syllabus they updated. First exam, you among all you give priority to all these questions. If it's already come, since see, for you it's very easy now to figure out, because if it has come like previous question, already I have shown you. So you give second priority, study it, but these questions top priority. Yes, are you clear now? So now this is my value of the closing stock. This includes two elements, fixed and variable. Variable is allocated based on the actual hours, fixed is allocated based on the normal capacity. Have you understood this? Ask me, no? Is this 0.6 is variable is not sitting? Is there not breakup there 0.2 and 0.4? Clear? Clear, students, everyone? See, really, we'll spend time here, we'll not rush. Okay, no? Comfortable? Now, how much is my COX? So, second thing they asked you, how much is the COX? Second, COX. Cost of goods sold. Can you tell me, students, how much is my COX? Now, COX depends upon your inventory valuation technique. COX is the balancing figure, or inventory valuation would have happened. Okay. See now, first of all, how much units sold out of current production? Because if you follow FIFO method, all opening stock is already part of COX. Out of the, since you followed a FIFO method, the closing inventory what you find is coming from the current year production, which you calculated to 0.6. That's why opening stock you didn't consider there, opening labor hours or whatever cost. So how much units you have sold out of current year production? Sorry, how much you produced during the year? Minus how much is under the what is that called, opening stock? 25. So did you sell 4200 units out of the current year production? See, 6700 is the total units produced during the year. Out of this, I think, 2500 is the closing stock. No, Do you have any opening stock there? 2300 opening stock. Yeah, correct, correct. See now, see 6700 is what you manufacture. What is the cost of per hour? 0.6. Leave it. Out of 6700 labor hours, how much is, did you sell all 6700? No. Out of this 2500 has been sold from the opening. So 4200 is sold out of the current year production. Will you multiply this from the labor hours? No, this is number of units. No, this is number of units. Exactly, I am telling you, this is 1 and 1, it is same here. They will catch you in, maybe they may catch you in the examination where they will not give you 1 to 1. Otherwise, I would have solved this problem in some other method. No, very simple method like this, I would have solved it. You will never realize that this problem is what. In fact, I did also in one of them. Then I realized that this is a risk I am taking. Because if they move that labor hours and rate, no, then it is going to change. So now, what is your hours, total hour, what is it called, total hours for 4200 units? It is 4200 hours. What is your cost per hour? 0.60. So 2520 is something out of the production going into COGS. I'll give you the breakup. Let us discuss and understand. I'll give you the reconciliation so that you are very clear. So you are clear now about this. See, this is the sold units. We are looking COGS. COGS is coming because of the sales only. Yeah. Last year's the stock. Last year's closing stock. This was opening stock. That value will get added to this. They have not shown it. Okay, have they given you the value of the opening stock? To add it. To add it. Have they given me the value of the opening stock? Then I can add it. Otherwise, what is my total COGS? This plus my opening stocks value. 6700 into. See, if you do 6700 into 0.6, then I will ask you one question. Don't you have closing stock at the end of the year? Is it coming from where? LIFO method? Did you sell all the thing from the whatever you purchased, produced? No, you have sold all the things starting from the opening stock. So if you remove opening stock, that means out of 6700, if first you sold all your opening stock, then whatever balance you have sold, no, it is coming out of the current year production. So this unit, so see 4200 plus 2500 gives you total sold during the year. Out of this, 2500 rupees cost is nothing but the opening stock value, which is the last year balance sheet value, which they didn't tell you. What they are asking you, during the year what you incurred, out of this how much you will allocate to the COGS, out of that 1500 plus 2600, how much you will charge to the P&L and how much you will charge to the inventory. Then you would have taken this plus assuming FIFO, you would have added that opening stock value and this is my total cost. But the question is not that, no. Their question is you incurred 1500 plus 2600 during the year. Is this incurred to manufacture the opening stock? No, this incurred for production during the year. So out of this total cost, how much you will give to inventory, how much you will go to COGS, and how much will be P&L. Now why P&L? COGS and P&L are same. Why P&L? Because there is an inefficiency. If inefficiency was not there, there would have been only two breakup of this. What should I write? Yeah, maybe language. What should I say? Understood. Okay. Now makes sense. Okay, if I tell you like this, overhead cost allocated to COGS. How? From the sales, if FIFO is followed, I will take that opening stock and then find out the number of hours, multiply this, get this value. Okay, done. Next, third item. How much is the charge to P&L out of this overhead cost? Did any overhead cost went to P&L? Which one? See, first of all, none of the elements of variable cost will hit your P&L account. Why? It is inventorized, or if it is sold, it has gone to COGS. But when it comes to fixed cost, there can be two elements. If you are efficient and if you are more than efficient, there is no hit to P&L account, because that would have loaded on the value of the closing stock. Please spend time on this. But since you are inefficient there, some portion will go, no? So how much? So write fixed cost, how much? 1500 minus how much is allocated to production? See, 1500 divided by 7500, it is the normal cost per hour into 6500 is your actual production, actual labor hours. 1500 divided by this is what you should allocate, 1300. So 200 will go to your P&L account. Are you clear? Now let us see the breakup of this. So they should get a very clear picture. I'll explain. So you incurred a total cost how much during the year? During the year, how much you incurred? 4100. Can you give me the breakup of 4100? Means where it has gone, 1500. If you say nothing is there, sir, everything will find in the P&L account. Will everything will be there in the P&L account? Okay, so now my reconciliation will be total is 4100. Out of this closing stock will go to the P&L, it will hit 200. COGS allocated to COGS will be on this heading is correct, no? Allocated to cost 1050. This is the breakup of this. I hope you are clear. Yes, Shruti. It depends upon your whether you are followed weighted average method or FIFO method. If you have followed the FIFO method, then the closing stock, opening stock value will be added to the COGS. And the closing stock value will be the taking it from the whatever new production is happening. If you say weighted average, then opening, I just showed one, I started with that one watermelon example. No, you add both, get one average price, and you value, then single from that average price, one leg will go here, another leg will go to the inventory. You are able to visualize, no, when I am explaining. $6,700. One, 6,700 into 1 number of hours. See, they will catch. Here it is simple and you will straight it. What if it takes 1.2 hours into 0.60? Okay, so now just see, reconciliation they didn't ask you. Okay, they simply asked you 3 cost, you told 3 cost. To look into this format, see, opening stock quantity only told, they didn't tell you the value. Overhead cost, how much? 1500 plus 2600, you passed expense account debit to bank. At the end of the year, sales you said, say for example, 8000 rupees, for example. Closing stock will be 1380. Now, that is going to get hit. So, 4100 is there, 1380 you will bring this side. So, balancing figure is these two numbers will be 1. It is hitting your P&L account. COGS also will hit P&L account. Since you didn't load it on the inventory, it's also going to hit your P&L account. That's why they call it charge to P&L. Okay, so I'll give you for your understanding sake, you can go through. So this is the alternative way of presentation. And this has got COGS to 2050 and the P&L. This is what I'm trying to tell. The total COGS has got this to break up. Means you bring inventory on the negative side. So what is your P&L? It's a COGS, where you have got COGS and P&L. Okay, so I will show you the ICA format for the above problem is given below. So what they have done, see please, worst case you can do it my way. If you can understand in the ICA way, you can do it that way. First step is same. Allocation of overhead will be done based on the labor hours. Why? This is the assumption because it's the labor intensive. Then they said calculation of labor hours per unit of output. We also done this. Now they said fixed overhead rate per hour. Rate per hour. We also done fixed overhead cost. So since the actual production is less, so they have done taken 0.2 and distributed this 1500 into 2 elements. Variable overhead will be allocated an actual hours, so 0.4 here, variable overhead rate per hour. Then allocation of the overhead cost 0.6 into 2300, 1380. So many steps they have done. Now, if you can do all these steps, maybe for a step mark purpose they can do, otherwise you can save time by doing my format. What I have done, I have taken, no same, that's what I am telling, but if you open the study material, you see so many steps are there. Just to like circling, first they calculate this fixed overheads allocation, one more working note for variable overhead allocation, then the third step they include both and do it. What I have done, I have clubbed it and given very crisp steps there. So it's like a risk, what, 1 or 2 step marks we may lose it if we don't do it. So that you decide, when practicing you decide whether to do it on this basis. It's the same, not different. I have clubbed the steps, followed, no? So finally is the reconciliation of the cost, everything is same. No doubts? Reconciliation not required. They didn't ask you, they asked you what is the cost to be allocated, you just tell the cost. This I am giving so that, see when I give this you appreciate it better, this particular question. Otherwise all half of will remain, something they say charge to P&L account. So I am presenting you to show that look how it works. Clear? Yes, one more RTP question. A company normally produced one, from now onwards no issues. That is one particular problem because of that labor hours, no, it is irritating. Now onwards very simple life. Company normally produced 1 lakh units of high precision equipment every year for over past several years. In the current year, due to lack of demand, it produced only 50,000 units. Okay, so understood that there is an inefficiency. And allocation should go based on the normal hours. Now the further material is given per unit, labor is given per unit, fixed overhead is given per unit. See, when they are giving you all this per unit, you explain in per unit only. If they give you all in cost, you explain all the way, your way. You can convert variable into total amount or absolute amount, you can do it in per unit basis unless they tell you specifically. Now fixed overheads is 1 crore, selling overheads is 50, variable selling overheads is 150. Will you consider this factory overhead? Will you allocate this factory overheads? Will you allocate variable manufacturing overhead? Yes. What about the fixed factory production overhead? Selling overhead? No. Variable? No. But if you want 1 mark, tell that we are not going to consider it. Calculate the value of inventory per unit as per Ind AS 2. What is the treatment of the fixed overheads? How many questions? 2. And what is your answer for the second portion? What is the treatment? Same story. We have to take there and say, since it is less than this, so and so. Can you do this? Can you give it a try? I just want to know, see, inventory cost per unit. See, there are two ways. You can always calculate per unit, per unit, per unit. Remember that 136 plus 10, you said per unit basis only. Then divided by. Otherwise, you can find out the total absolute values and divide last. Or divide every item get on per unit basis only. That's left to your choice. You look at the question. Just tell me one number. This is my inventory cost per unit. I understand that you have understood it. Yes, students, so please pause the video and do full, okay? All questions you answer, not just calculate the amount and tell me. Whatever they asked, please do it. Okay, students, so we'll check the answers. First thing is, they asked me inventory value. Straight away I have seen you have done it. So last portion, be careful. It is based on the normal capacity, 100 per unit. So it is 500 rupees per unit. Now you need to tell that selling cost will be excluded and whatever they will be charged to the P&L account. Because we are not going to load it on the inventory. Yes, any mistakes here in this 500? Oh, what happened? Sorry? What mistake happened? No, tell me now. I want to understand. See, fixed overheads was 1 crore and your normal capacity is 1 lakh. What did you consider here? Which amount you considered? No, absolutely above. You should feel happy, in fact. You should feel pride for making mistake. Learning. What amount you have put? Okay, but have you multiplied all this with the actual production? Then you added this. So how much you get? No, but if you see, there is one inefficiency. How can you add entire value to the? You cannot add. You should have added only the proportionate amount. Balance will go to your P&L account. Okay, understood the mistake, no? Anyone else? Any other mistakes? Next treatment, you should say that, look, since it is less actual production, we will absorb on the normal capacity. Does your answer has got two numbers here, 50 lakh, 50 lakh? Have you written these two breakup? Yes, yeah. Yes, that's it. So we'll move on to the next question. Which one? Yeah, what happened? Instead of per unit, okay, previous one you're talking. You want to do it in total value. You can do, no? How much is actual production? How it will be different? See, you material cost is 200 per unit into, you multiply by how much, how many units? 50,000 units. Labor cost is 100 into 50,000. This is also 100 into 50,000. And how much you will absorb here? Here into 50% only. And entire 50,000, no? 50 lakhs only you will absorb. Divided this entire total value, you divide it by 50,000. You should get 500. Clear, no, Shruti? They asked per unit. See, ultimately, that's what I told you. There are two ways of approaches. Clear, no? 75 lakhs. On what basis? That's what, no? This is the confusion. If you take some other basis, then you will get this. So, take, how did you get 75 lakhs? Okay, but they said, no, here they were produced only, but where is 75,000 here? Previous question. See how your mind fools. So many instances, correct, no? Not there, but our mind remembers something. So I will definitely, students, maybe for your practice, I'll try to do that. I'll try to give you different questions. You should solve different questions. Same question means this problem will be there. Or be careful more in the examination. That means this also can happen despite you know things very well. Whose fault? Correct, no? Chalo. ABC manufactures control unit for air conditioning system. Now you have got one component of X is cost 1205 each, and one component of Y cost 800 rupees each. This is what material cost to manufacture that X and Y. Now sundry raw materials cost is 150 rupees. This air conditioning system has got some components plus raw material. Company faces factory rent, should be part of inventory. Energy, selling, no. Each unit takes 2 hours to assemble, and the production workers are paid rupees 300 per hour. What is this? Labor hours. So you need to check how much is the labor hours. Production overheads are absorbed into units using hourly rate. The normal level of production per month is 1000 hours. And what is your normal hours? Okay, what is your capacity? Sorry, have they told you? Wait, but each production overheads will be labor on hourly rate. No, they said on hourly rate. Now, what is your cost of inventory here? Okay, so what does my cost of inventory includes? See, first of all these things are fine. Now let us focus only on one heading, which is a irritating thing, which is your production overheads. Okay, how much is your production overheads? They said the production overheads are absorbed into units of production based on the hourly rate. What is your hourly rate? 300. So you need to charge for the inventory whatever you produce based on the hourly rate. So how many hours you will charge or load on the inventory? 2 hours into 1 unit. So what we can do, we are going to calculate the, okay, determine the cost of inventory, they say. Question is very silent. So what you will do? There are two options. One, value of inventory you can calculate, or per unit you can calculate. If you say value, then you should multiply with the actual production, as I told you. No, so I don't have any option to here. So on per unit basis only I have to calculate. And overhead is very simple and straightforward given here. Understood, no? Yes, can you do this? This is one AC. Like at the end of the time, end of this day, you should tell me what is the cost of one AC for me, which is not sold, which is lying with me now. I have manufactured one AC, I not sold it, it's lying with me. So how much is the cost of that AC to be shown as an inventory in my balance sheet? They use the verb determine, but nothing they have specified here. So we can ignore that verb. So you can pause the video and do it. So we'll compare the answers. Hope you have not made any mistakes. Didn't understood? Okay. See, ABC manufactures one control unit for air conditioning. So they are manufacturing AC only. To manufacture that AC, you incurred X and Y component, some fan and this thing. Its cost is this. Straight away you say, sir, if I have got an AC with me, this cost will be part of inventory. Some sundry raw material, pipelining and all, is it part of my inventory? Then you have used the following monthly expenses: factory rent and energy cost. Okay, is this cost of the factory rent and energy cost, how much you incur? 16,500 plus 7,500. Okay, and how do you allocate this factory cost? Okay, some allocation we need to do, we'll check that. That's it. Once we allocate, we get the, allocation, we'll see that. Okay, first of all, component X, component Y, raw material cost you are going to distribute. Clear? Now comes the labor cost. What is your labor? To manufacture this AC, you spend 2 hours. So 600 rupees you will give. Now comes the production overheads. So production overheads, so for 1 unit, it will take 2 hours and you will charge it based on 24 rupees per hour. How did you get 16,500 plus 7,500? Selling cost you have ignored, divided by 1000 hours. So 1000 hours is what here? Normal level of production per month. Okay, so you got normal rate per hour. And what is your normal, how many actual hours? 1 unit you took 2 hours. You got 48 rupees. Yeah, I'm sorry, maybe I might have told production hours are absorbed into units production using an hourly rate. Okay, I probably I misinterpreted while telling you. I thought it is 300. No, it's not 300. Labor charge is 300. This production cost you are going to allocate based on the normal capacity. So that's what, when you see the production cost, look for normal capacity. Normal capacity is 1000 hours into actual hours. Actual hours is for 1 unit 2, and this is something very similar to our, this allocation is similar to our first question what we have done. So you allocate this 24 rupees for 2 hours. Yeah. Which one? I didn't. Number of, but allocation should happen based on number of hours, no, not number of units. No, we can calculate. In fact, the previous problem also we can calculate. Yeah, because they told for 1 unit how much hours it's going to take. I can do it and it looks very simple also. I am telling you. But I am telling you, see, when they specifically told me allocate the production using hourly rate, you have to allocate. Otherwise, why? That problem you would not have asked me any question only. No, now also you didn't ask me. If you do it on production basis, no, it is very easy. Hourly rate is a irritating thing. So this is like a brother of that question. Same. Followed, no? Here, no, that problem it will be there. Here I don't know. Here, because it's not, there is no separate calculation, no? Or maybe there, I don't know. Are you clear? Yeah, maybe they may allocate it because this is the catch, no? Otherwise, every number is very easy there. Straightforward number. So entire catch lies in this particular number. Yes, so with this and one heading you write, selling and distribution heads are not part of the inventory. With this, yes, majority, like big chunk we can say of this particular sub chapter we have done. So next we can move to the inventory valuation techniques.